I have been instructed that you have to deal with the controversies arising under the new law, as well as to take into consideration the precedents which have come in the context of new law. So I have done my research. I have found out some judgments of the high courts in the context of new law, and today we'll be discussing that. So today I will be discussing the intricacies and the controversies under the new act. What are the points which one can argue, as well as the judgments which have come in this area which we can rely upon. I will not be touching the old provisions of the Income Tax Act 147, 148, though the litigation under those provisions are still pending. I will also devote some time towards this controversy of notices issued before 1/4/21 and 30th June 21, especially after the controversy has become more hot and subsequent to pursuant to this judgment of the Gujarat High Court in case of Kinara Industries and the Allahabad High Court in case of Rajiv Bansal, wherein they have distinguished Delhi High Court judgment. A number of controversies in that area as well, which we will discuss, but very briefly because matter is sub judice and everybody is aware that what are the arguments and etc. So with this, let me start with the presentation. A brief background. Under the Income Tax Act, we follow a concept of self-assessment. Self-assessment means an assessee has to compute his own income. He has to estimate his income, pay advance tax. He has to file his own return of income, disclosing his income, and he has to pay self-assessment tax. So the concept is that the government trusts the taxpayer, and they trust the taxpayer that you will compute your income correctly and you will pay self-assessment tax correctly and disclose your income correctly. As a result, less than 1% return of income have been taken up for scrutiny. We have some sort of assessment of the Income Tax Act. One is a summary assessment under 143(1). Though after 1999, the government wanted to reduce controversy in respect of intimation under 143(1). But after 2008, bringing out the amendments in 143(1) prescribing for prima facie adjustments, the scope of the section has kept on increasing. And now we see major controversies, major litigation in respect of intimation under 143(1) of the Act, primarily because the same is done by computer, not by human being. So therefore, they are not able to understand our contentions, etc. We also have summary scrutiny assessment under 143(3) and 144, and I am told that the number of scrutiny assessments have reduced. As well as we have reassessment under section 147 of the Act. Prior to 1/4/21, we had a separate section for search assessment under 153 and 153C, which have now been merged with reassessment provisions under 147 of the Income Tax Act. Then you also have revision of assessment under section 263 and 264. 263 will apply if the order is erroneous and prejudicial to the interest of the revenue. That means they can do a 263 proceeding for the benefit of revenue. A 264 proceeding is where assessee wants some relief and he files an application under section 264 to the commissioner where there is no other remedy left. So 264 is something which is in the benefit of the assessee. And then you have something called as rectification of assessment under section 154, the scope of which is very narrow because it only deals with mistake which is apparent from record, and we have Supreme Court judgments, number of judgments to narrow down the scope of section 154. Lastly, before proceeding forward, the Supreme Court, as old as 106 ITR 1 Parshuram Pottery versus ITO, they have laid down that there has to be a concept of finality to assessment. What they write is we have to bear in mind that the policy of law is that there must be a point of finality. And all the legal proceedings at stale issue should not be reactivated beyond a particular stage. And that lapse of time must induce, repose, and set at rest judicial and quasi-judicial controversies, as it must in other spheres of human activity. Bringing out the new reassessment provisions with effect from 1/4/21, frankly, this judgment has not been taken into consideration because the judgment says at some point of time you have to stop, which was 6 years and 16 years in case of foreign income or foreign assets. But now they have increased the time limit from 6 to 10 years. So our Honorable Finance Minister very proudly claims in her speech that they have reduced the time from 6 to 3 years. Rather, I would say they have increased it from 6 to 10 years. So therefore, we are also to keep in mind the concept of finality to assessment. We already discussed that the number of scrutiny assessments have reduced under 143(3). The time limit to issue notice under 143(2) is 3 months from the end of the financial year, and you have to complete it within 12 months from the end of the assessment. Nowadays, the government is more focused on information-driven assessments. So a search will happen, or a survey will happen, or a verification will happen, and the different assessing officers or the different officers of the department would feed in the information in the system, and the system will throw up this information to the respective assessing officers. This is what the government is trying to do in future, and they started this and they're going to do this in future. As a result, what my personal feeling is that under the guise of reducing the time limit from 6 to 3 years, I personally feel that they have extended the scrutiny assessment provisions from 1 to 3 years, because the scrutiny assessment or the reassessment provisions up to 3 years is, according to me, now the new scrutiny assessment provision. Further, under the guise of restricting it from 6 to 3 years, they have extended the reassessment provisions from 6 to 10 years. So this is, I think, now going to be a norm. There will be lesser number of scrutiny assessments. You will get more of 147 notices to be issued within 3 years. That is the new scrutiny assessment. And if they miss that bus of 3 years, then they're going to issue you notices after 3 years up to 10 years. With this, we'll run through the section and then the issues arising in each section. And we'll also touch upon the corresponding case laws which have come up in this section. Firstly, starting with section 147 of the Income Tax Act, which is a jurisdictional section to reassess an income. There is no need to read the section. We can just directly go on, because everybody must have read the reasons, read the section. The only point which one will have to notice is, whenever we are discussing or the intricacies of the new law, we have to compare the new law with the old law. And that is how we'll find out what are the differences, what are the lapses, or what are the deficiencies which have been filled in. And we can compare and we can find out the new intricacies. So under the old section 148, the jurisdictional requirement of issuing notice under 148 was an assessing officer has to have a reason to believe that income has escaped assessment. Now, if you read section 147, they say that if any income chargeable to tax in case of an assessee has escaped assessment for any year, then the AO may assess or reassess such income. So the words reason to believe have been removed from the statute book. And therefore, all the controversies attached to this word reason to believe may, at the first blush, it appears that these judgments will no longer be applicable. But we'll see as we go on that even these judgments are now becoming relevant. Old section 147 had one section, 3 provisos, and 4 explanations. Whereas the new section 147 has 1 section and 1 explanation. So one will have to gauge the impact of the removal of the provisos and the explanation, which we'll do it in our presentation. What is the implication of removing the word reasons to believe? So earlier, it was a very settled proposition that you must have an information in your possession which will lead to a belief that income has escaped assessment. There should be a live link or nexus between the reason and the belief that income has escaped assessment. If this live link or nexus is not there, then assessment cannot be reopened. At the same time, courts have held that at the stage of reopening, there is no need to conclusively establish income has escaped assessment. If a prima facie finding is given that income has escaped assessment, or from the reasons recorded, if one can find out that really income has escaped assessment or prima facie case has been made, then in that case, the threshold of reopening the assessment has been successfully crossed, and now you can proceed with the assessment proceeding. But this word reasons to believe have been removed. Now, what are the implications of that? If I am again read section 147, if any income chargeable to tax in case of an assessee has escaped assessment, the assessing officer may, subject to provisions of section 148 to 153, assess or reassess such income or recompute the loss or depreciation allowance or any other allowance or deduction such as assessment. From the reading of section 147, one may come to the conclusion that under the new section 147, there is no requirement of any reason to believe, correct? But now it has become much more stricter. Now, if he wants to reopen, he has to not only have a belief or a reason, but he'll have to conclude at the stage of reopening that income has really escaped assessment. Because the section says, if any income chargeable to tax has escaped assessment, AO may assess or reassess such income. So only if income has escaped assessment, you can start with the proceedings. And therefore, at the stage of reassessment itself, one will argue that you have not established that income has escaped assessment and therefore you cannot proceed further. In fact, in many orders under section 148 AD, we have seen that the AO writes in the order that at this stage, I have to just prima facie give a finding it's a fit case or not. And since I have information in my possession, which suggests that income has escaped assessment, and therefore nothing more is required to be done, you submit whatever you want to submit in the course of reassessment proceeding. With respect, one can still argue that at this stage, now you will have to conclude income escaping assessment and not only mere reason to believe. It's a possible argument which one can. Now, 147 is a jurisdictional section, and it says it is subject to provisions of section 148 to 153. So therefore, you can reopen provided you fulfill the conditions of section 148 to 153. At the same time, if your case fits in 148 to 153, but if there is no income which has escaped assessment, then you have not crossed the threshold of 147 proceeding, 147 section 147, and therefore you cannot reopen the assessment. So even if you have information suggesting income escaping assessment, still there has to be an income escaping assessment to reopen the assessment under section 147 of the Act. It's a main section, jurisdiction section, and conditions of section 147 has to be fulfilled. A very interesting controversy arises here. The section uses the word income which has escaped assessment. Now, assessment has been defined in section 29 to include reassessment. Assessment includes reassessment. At the same time, we have a Supreme Court judgment in case of Rajesh Javeri Stockbrokers 291 ITR 500, where they clearly write that 143(1) is not an assessment. If 143(1) is not an assessment, can one argue that 147 can apply only if there is a prior assessment under section 143 of the Income Tax Act? If there is no prior assessment under section 143 or 147 of the Income Tax Act, then you cannot reopen under section 147 of the Act. To my mind, you can argue this. But then there will be a cross question that similar wordings were present in the earlier section 147. There again, the wordings were, if there is any reason to believe that income has escaped assessment, then he can reopen. There again, the word was escaped assessment. Correct. The word was income, or word was income escaping assessment. But at the same time, they had explanation 2 to section 147. And if I just read section 147 explanation 2 for a moment. For the purpose of this section, the following shall also be deemed to be cases where income chargeable to tax has escaped assessment, namely, and clause B stated that when a return of income has been furnished by the assessee, but no assessment has been made, and it is noticed by the AO that assessee has understated the income or has claimed excessive loss, deduction, allowance, or relief in the return. So under the old 147, there's a specific explanation to clause B, which stated that you have filed your return, but there is no prior assessment. It shall be deemed to be a case where income has escaped assessment. Now, explanation 2 to section 147 is no longer in the statute book. And as a result, the consequences are, for the purpose of section 147 under the new law, income escaping assessment, one can argue that there should be a prior assessment under 143(3) or 147 of the Income Tax Act to reopen under 147 of the Act. If we succeed, certainly there will be a retrospective amendment immediately coming up. The next point is, if reassessment is beyond 4 years, under the old law, we had this concept of failure to disclose truly and fully all material facts, first proviso to section 147. This concept has now been removed, and therefore now there is no requirement of failure to disclose fully and truly. Even if you have disclosed everything in your return of income or in the assessment proceedings, still they can reopen under section 147 of the Income Tax Act. Also, the third proviso to section 147, which was existing, which stated that assessing officer may assess or reassess such income other than the income involving matters which are subject matter of any appeal, reference, or revision, which is chargeable to tax and which has escaped assessment. So therefore, under the old section 147 third proviso, there was this third proviso which stated that if there is an appeal, reference, or revision pending, and the matter in respect of which you want to reopen are subject matter of appeal, reference, revision, then you cannot reopen. This was on the basis of doctrine of merger. Now, this third proviso again is missing in the new section 147 of the Income Tax Act. Therefore, the department can very well argue that even if any issue which forms the subject matter of appeal, reference, or revision, I can still reopen your assessment under section 147 because there is no bar or there is no embargo. However, my personal view is this doctrine of merger is a judicial doctrine, is an accepted principle. It will result into an ambiguous outcome because same issue gets considered by the assessing officer as well as CIT appeal or the commissioner. Now, this cannot be permitted. You cannot have two authorities, superior and inferior authority, both going into the same issue. Therefore, still, I think that you may have a chance to argue that if an issue is subject matter of appeal, then you cannot reopen under the Income Tax Act under section 147, dehors third proviso to section 147, which was already present in the earlier section. Now, as we already discussed, explanation 2 to section 147 is not there in the new section. And now, therefore, what are the consequences of such deletion of explanation 2? Please look at the wordings of section 147 again. I use the word, if any income chargeable to tax has escaped assessment, AO may assess or reassess such income or recompute the loss or depreciation allowance or any other allowance or deduction for such year. Now, in the first part of section 147, the jurisdictional condition is income should escape assessment, and income connotes a positive income. Because in the second part they write, assess or reassess such income or recompute loss or depreciation allowance or any other allowance or deduction. Therefore, loss, depreciation allowance, other allowance and deduction have been used distinctively from the word such income, and therefore one can argue that you can only reopen if a positive income has escaped assessment. You cannot reopen to disallow my loss, to disallow my depreciation allowance, or disallow my any other allowance or deduction in any other year, or deduction for any year. Now, this was also the wording under the old section 147, but there again, explanation 2 categorically provided that they can reopen and it will be a deemed case of escapement of income if you have understated your income or if you have claimed excessive loss, deduction, allowance or relief in the return. If we read explanation 2 clause B or clause C, it has been clearly written that where an assessment has been made but such income has been assessed at too low a rate, such income has been made subjective of excessive relief under this act, or excessive loss or depreciation allowance or any other allowance under this act has been computed, then you cannot, then you can, it's a deemed case of escapement of income. This explanation is not continued under the new section. The jurisdictional requirement to reopen under the new section is there should be escapement of income, and income has been used distinctively from the words loss, depreciation, expense or other allowance, and therefore they can reopen only if a positive income has escaped assessment and not otherwise. So this I prima facie feel it's a very good case to argue that you cannot reopen to disallow this because the jurisdictional requirement will not be satisfied. And if we succeed, then of course we'll have a retrospective amendment introducing similar provisions like explanation 2 in section 147 of the Income Tax Act. Also, for example, if you have already offered some income to tax, but according to the department, that income should have been taxed not at 20% but at 30%. That again will not be a case for reopening the assessment because there no income has escaped assessment and there is no deeming fiction as contained in explanation 2, where again they have stated that if income has been assessed at too low a rate, then it's a deemed case of escape. So, for example, in case of penny stock, you have earned short-term capital gain. Your sale consideration is 60 lakhs. You have taken cost of acquisition of 10 lakhs. You offered 50 lakhs as short-term capital gains. Has been offered to tax at 15% under section 111A. Now, AO forms the belief that 60 lakh has escaped assessment because it's a penny stock transaction. It is in the nature of accommodation entry. You can argue, I've already offered 50 lakhs to tax as short-term capital gains. Such income cannot be said to have escaped assessment. At the most, 10 lakhs must have escaped assessment. And if it is beyond 3 years, since the threshold of 50 lakhs has not been satisfied, you cannot reopen the assessment. Or a second example, during demonetization, receipts in cash deposits, one must have already offered it to tax as business income by taking it as sales or etc. But department has right, left, and center considered such cash deposits as unexplained cash credits and offered and taxed it under section 68, etc. So suppose in your case, you have deposited some cash in demonetization period, no prior assessment. Now they want to reopen on the ground that cash deposits constitutes income escaping assessment because it's your unexplained cash credit. You offer an explanation that I have deposited 30 lakhs or 50 lakhs cash and same has been offered as sale in my profit and loss. Department will argue, no, you're not explained the source, therefore this should be taxed under section 68, read with section 115BB at the rate of 60%. The only controversy here would be the rate of tax. For the purpose of rate of tax, according to me, they cannot reopen because no income has escaped assessment. The last controversy in respect of section 147 is, if they reopen an assessment for making addition in respect of A issue, can they make addition in respect of B issue without making addition in respect of A issue? Or so one of the view is that there was this Bombay High Court judgment in case of Jet Airways, which was followed by subsequently by number of judgments, which held that if you don't make addition in respect of the income in respect of which you have reopened the assessment, then you cannot make addition in respect of other items of income. And this conclusion of the Bombay High Court was based on the wordings of section 147, which was then existing, which stated that assess or reassess such income and also any other income chargeable to tax which has escaped assessment. So you have to assess or reassess such income and also any other income. So the focus was on the word and also. Now that wordings have been done away with. Therefore, one of the view is that Jet Airways is no longer applicable, and therefore they can even make addition in respect of the other issues, which is not subject matter of reopening of the assessment, if the main issue on which assessment has been reopened has not been added. At the same time, there is a very strong view which also prevails that for the purpose of section 147 of the Income Tax Act, you could have reopened only if you had conclusively formed a belief that income has escaped assessment. The very fact that on the issue on which you have reopened, no addition has been made means no income has escaped assessment, and therefore the assumption of jurisdiction under section 147 itself is incorrect. And once that is the case, I succeed on the main ground that 147 jurisdiction is bad in law, and therefore even the other addition should not be made. Mind you, under the old provisions, we used to argue that reassessment is validly carried out because you had a reason to believe. However, you cannot make an addition. Addition has to be deleted because issue on which assessment has been reopened, that itself is not subject matter of any addition. But now under the new law, we will have to argue that at the first stage itself, 147 proceedings could not have been initiated because your assumption of jurisdiction itself is based on a wrong fact that income has escaped assessment. Since you yourself agree that there is no income which has escaped assessment, therefore jurisdiction is bad in law, assessment proceedings go, there is no question of making any other addition. So the two school of thoughts, and according to me, both are valid. At the same time, if you go with the first school of thought that, okay, yes, you can make the addition because the database is no longer valid, then I should draw your attention to that wordings of explanation to section 147, which states that assessment or reassessment or recomputation in this section, assessing officer may assess, reassess the income in respect of any issue which has escaped assessment, and such issue comes to his notice subsequently. The such issue should come to his notice. There's a difference between coming to his notice and digging out issues, which means you cannot make fishing and rowing inquiry in the course of reassessment proceeding. For example, if the assessment has been reopened to verify your purchases, he cannot issue you a notice saying through unsecured loans. That cannot be possible because then you're making fishing and rowing inquiries. And in this regard, if you go through the SOPs issued for faceless assessment, the first notice under section 142(1), which they have to issue, that's a questionnaire, has to be specific and focused on the information and evidences in respect of the point on which assessment has been reopened. So your first 142(1), they can only ask you specific queries on the issue in respect of which assessment has been reopened and no other issue. Therefore, the proposition which follows is you cannot make fishing rowing inquiry in the course of reassessment proceeding. However, at the time of making inquiries in the course of reassessment proceeding in respect of purchases, he asks you to furnish details of creditors. And from creditors, he finds out that some of the creditors are old and he wants to make an addition under 41(1). That is permissible because that information has comes to his notice subsequently, has not dug out for all those information. But if he directly starts with questions on some unconnected issues, you can very well put your foot down and ask him to restrict himself to the issues in respect of which assessment has been reopened. Also, here there is one more twist. If you look at the explanation to section 147, they write that for the purpose of assessment, reassessment, recomputation of this section, assessing officer may assess, reassess the income in respect of any issue which has escaped assessment, and such issue comes to his notice subsequently. Therefore, again, the power to make addition in respect of other issues is only in respect of income and not in respect of loss, depreciation allowance, or any other allowance or deduction. So one can also argue that you have reopened to assess my income. Now you are adding that or not adding that. You cannot add or you cannot disallow my loss or expenses because the power under the explanation given to you is to assess income in respect of any other issue and not in respect of depreciation allowance or any other allowance or expense. So this, I think I've taken care of section 147 of the Income Tax Act. We move forward to section 148. 148 says that before making any assessment, reassessment, or recomputation under section 147 and subject to provisions of section 148A, assessing officer shall serve on the assessee a notice along with the copy of the order passed, if any, and require under clause D of section 148A, require him to furnish a return of income in the prescribed manner, and if the return is filed, it shall be treated as a return required to be furnished under section 139 of the Act. Now, in my presentation, you will find something which is there in red and something which is there in golden color. Red is the amendment carried out by Finance Act 2022, and golden color is the amendment which is proposed by Finance Act 2023. Just to clarify. Then there are provisos that you cannot reopen under section 147 unless you have information in your possession which suggests that income has escaped assessment and where prior approval has been obtained. However, where order has been passed under 148 AD, then no prior approval is required for issuing notice under section 148. What do you mean by information suggesting income escaping assessment has been defined in explanation 1? Earlier there were 2 categories, now there are 5 categories. Then explanation 2 states that in the following situation, it shall be deemed that the information assessing officer has information which suggests that income has escaped assessment in the following 4 situations. And lastly, they say that explanation 3 states that approval for this purpose will be taken of the specified authority as specified in section 151 of the Act. Now, coming to the issues. Section 148 again starts with before making any assessment, reassessment, or recomputation under section 147, which means 147 is a jurisdictional section and you can only make an assessment under 147. And therefore, conditions of section 147 still continues, which means AO has to form a belief that income has escaped assessment. Mere information suggesting income escaping assessment would not be sufficient. Section 147, the main section is similar to section 148, which we had in the old law, which requires an assessing officer to issue notice and the assessee to file a return of income on issuance of notice. Some of the controversies attached to this issuance of notice and filing of return of income is A, such notice must leave AO's hand before the last day. 2, notice cannot be issued on a deceased assessee or an entity which is no longer in existence. 3, it should be served at the correct address, email address. Service on the portal is not a valid mode of service. 4, notice must be a signed notice. And 5, after I file my return of income, notice under section 143(2) has to be issued. Further, section 148 writes that a new procedure under section 148A has been prescribed, and therefore before issuing any notice under section 148, it has been specified that it is subject to provisions of section 148A, and 148 notice shall be served along with the copy of order under section 148 AD, which means both section 148 and 148A are jurisdictional sections, and therefore even if one of the two are not followed, the entire proceeding will collapse. In fact, Supreme Court in case of Ashish Agarwal has held that section 148A is a condition precedent. Clearly, Supreme Court has held that it's a jurisdictional section, and if you don't follow the provisions of section 148A of the Act, then according to me, the proceedings under section 148 and 147 have to collapse. Now, when can a notice under section 148 be issued is if there is an information with AO which suggests that income chargeable to tax has escaped assessment and with the prior approval of specified authority. And this term has been defined in explanation 1 to section 148 as to what is the information which suggests that income has escaped assessment. Explanation 1 says that for the purpose of this section and section 148A. Now, please mind this explanation is only for the purpose of section 148 and 148A. It is not for the purpose of section 147. For the purposes of this section and section 148A, information with the assessing officer which suggests that income has escaped assessment means, therefore, the definition is an exhaustive definition. Only if the information falls in the 5 categories, they can reopen. Otherwise, they cannot reopen under section 148 of the Income Tax Act. Let us go step by step in respect of each information. Any information in case of the SSC for the relevant assessment year in accordance with the risk management strategy formulated by the board from time to time. Now, what is this risk management strategy? Nobody knows. Has it been formulated? Nobody knows. What I have been told is there is nothing formal about this risk management strategy, and anything which crops up on the inside portal will fall in clause 1 to explanation 1 to section 148. Though this may be the practical scene, but technically, theoretically, and legally, there has to be some strategy formulated by the board. What do you mean by the word strategy? Something written, and it is already formulated by the board. There has to be something written somewhere that these are the cases where you will reopen the assessment. And unless and until department shows that this is the risk management strategy, and unless and until department shows that your case fits in the risk management strategy, they cannot reopen the assessment. Till date, the courts have been asking questions to the department councils about this risk management strategy, and nobody is able to answer. Forget the SSC's council, even the department's council are not able to answer what is this risk management strategy. Forget department's council, even the assessing officers are not able to answer what is this risk management strategy. The only answer which they give is the information suggesting income escaping assessment is based on the information received on the inside portal. That's it. If you read the entire section 147, 148, 150, 150, etc., all sections, not a single place where they have written inside portal, not a single place where they have mentioned ITBA portal. What they have written is risk management strategy. Somebody will have to prove in the court that risk management strategy is equal to inside portal. Till the time such thing is done, according to me, a very good case to argue that there is no risk management strategy, and let the let the department prove that the case fits in the risk management strategy. Does the information which is flagged in the risk management strategy have to be a new tangible material? Answer appears to be no. This concept of new tangible material may not be that relevant insofar as information suggesting income escaping assessment is concerned, though it may be relevant from 149 1B perspective, which we will discuss later. So this is 1. 2. The second category of cases, any audit objection to the effect that assessment in case of the SSC for the relevant assessment year has not been made in accordance with the provision of the Act. Earlier wordings were any final objection raised by the Comptroller and Auditor General of India to the effect that assessment in case of the SSC for the relevant assessment year has not been made in accordance with the provisions of the Act. So, the old provision which was existing for financial year 21-22, which covers all the cases after in respect of Ashish Agarwal case, department could have reopened under this clause if there was any final objection raised by Comptroller and Auditor General of India to the effect that assessment has not been made in accordance with the provision. So there should be a final objection by C and AG. And now they have changed it to any audit objection to the effect that assessment in case of the SSC has not been made in accordance with the provisions of this. Firstly, there's a stark chain. So for all the cases which are still going on pursuant to Ashish Agarwal case, if your case is reopened based on audit objection, you have to ask them, please give me final objection of the C and AG. Revenue audit objection is different from final objection of C and AG. Had it been same, there was no need to amend the provisions. And according to me, C and AG has very little role to play in the audit objections of the income tax department. These are the internal audit party of the department which does the audit, and therefore, until and unless they give you a letter that these are the final objections of C and AG, you cannot reopen for financial year 21-22. After financial year, after 1/4/22, now the requirement is there has to be an audit objection to the effect that assessment has not been made in accordance with the provision of the Income Tax Act. Now, first and foremost, they have used the word assessment has not been made in accordance with the provisions of the Act, which means this clause will apply only if there is a prior assessment. That is, only if there is a 143(3) or 147 assessment. And I am told that even the audit department looks into only the assessment papers and not the 143(1) papers. So I'm, of course, subject to correction. Therefore, this clause can only apply only if there is a prior assessment under 143(3) or 147, etc. Then they have written, assessment has not been made in accordance with the provisions of this Act. Now here, if I just compare the old audit objection controversy with the new controversy, under the old section 147, the courts have held as follows. Firstly, if there is an audit objection that a particular expense has to be disallowed, and if the assessing officer reopens simply based on audit objection, courts have held that you cannot reopen based on the audit objection. You have to apply your independent mind. It cannot be based on borrowed satisfaction. Therefore, this is bad in law. At the same time, courts have also held that this issue was subject matter of consideration in the assessment proceeding, and therefore now it amounts to change of opinion, and that is not permissible. Both these grounds, the reassessment proceedings were quashed. 2, under the old law, if the audit department points out a new fact which was missed by the AO, then in that case, Supreme Court in case of PVS, PDS, and that, in such type of cases, assessment can be reopened by the AO. So if a new fact has been pointed out, then you can reopen. But if it is only legal interpretation, then you cannot reopen because assessment has to be reopened based on the satisfaction of the assessing officer. Can one say this argument of audit objection has gone? I personally feel the argument of audit objection has not gone. Explanation 1 to section 148 is merely a starting point. You will receive information suggesting income escaping assessment, but after considering my reply, you have to pass an order under 148 AD, and you have to give a finding that it is a fit case to reopen the assessment, and that the income has escaped assessment as required under section 147. But if you write in the order, no, this has come from audit objection, this is an information suggesting income escaping assessment, and therefore it's a fit case, then it should not pass the threshold of section 148 AD read with section 147 of the Income Tax Act, because you have just reopened based on the audit objection, which is a good starting point, but should not be the concluding point. So that argument, according to me, still survives. 2, has the argument of change of opinion gone? The answer is no. Change of opinion, one reads the judgment of Supreme Court in case of Calvinator. The old section 147 and prior to the amendment by 1989 Act, section 147, all throughout Supreme Court has persistently held that you cannot reopen based on same facts just because the successive assessing officer has come out with a new view, or you just change your mind. Just because there's a change of opinion, you cannot reopen. You cannot reopen to review the facts. And the Supreme Court in case of Calvinator has held that this is an inherent or an inbuilt test under 147. So even though section 147, as existing since 1961 till 2021, never had any exception that if this issue has been taken into account in the course of original assessment proceeding, same issue cannot be taken up in the course of reassessment proceeding. There was not a single word in the section. Still, the court imposed a condition that if you want to reopen, you cannot reopen just because you are changing your view. If an AO has already applied his mind in the course of original assessment proceeding, same issue cannot be revisited in the course of reassessment. This is an inherent or inbuilt checkup which will stay even after the amendment, because at the end of the day, you are reassessing the income, not assessing the income, and therefore its inherent test should stay. In fact, we go to the judgment of the Karnataka High Court in case of Wipro, where they have said that you cannot reopen to review the view taken earlier. So, A, change of opinion still survives, argument of audit objection still survives. You have to still come out with the finding that income has escaped assessment. It has to be the independent belief of the assessing officer and not that of the audit party. Explanation 1 is only a starting point that is sufficient for you to issue a 148A(b) notice, but after considering my reply, you still have to pass it on. The third clause is, third information is, any information received under an agreement referred to in section 90 or 90 of the Income Tax Act. This is the information which one receives from the foreign jurisdiction. Mere receipt of information is not sufficient. Such information should also suggest that income has escaped assessment. There is an information which the assessing officer has received that Mr. A has an investment in United States. He owns a flat worth rupees 1 million US dollar. Based on this information, can they reopen the assessment? The answer is no. If I hold a flat, how does that lead to a belief that income, how does that suggest that income has escaped assessment? Unless you find out what is the source of that flat, how have I acquired it, you cannot form or you cannot come to even a prima facie belief that income has escaped assessment. So mere receipt of information is not sufficient. Such information should also suggest that income has escaped assessment. The next category is any information made available to the AO under scheme notified under section 135A. 135 is a faceless collection of information, and nowadays many people are receiving notices from the verification unit, and it is as good as scrutiny assessment proceeding, I am told. So this is going to be the new phase of assessments. They'll issue notice, the investigating officer will issue notice, more or less like a scrutiny notice. You have to file your reply, then he'll form his own conclusion, forward that opinion to the assessing officer, and then the assessing officer can reopen your assessment. So this is what they're trying to do, but then it should suggest that income has escaped assessment. And the last item is any information which requires action in consequence of the order of a tribunal or a court. So probably this is to give effect to section 150, though the language of the section is little here and there, but it appears that it is to give effect to section 150 of the Income Tax. Now, having gone through this explanation 1 to section 147 or 148 of the Income Tax Act, we come back to the first question itself. The requirement of 147 is income having escaped assessment, whereas 148 says there has to be only an information which should suggest income has escaped assessment. Does that mean? So the two are different. One requires a conclusion income has escaped assessment, and one requires only a suggestion that income has escaped assessment. Does that mean that explanation 1 to section 148 is otiose, or does that mean that 147 is to that extent diluted? The answer is no. Because of this, explanation 1 is only for the purpose of section 148 and 148A. It is not for the purpose of section 147. This is a starting point. You, on receipt of the information, you either do an inquiry or issue a show cause. I have to file my reply, and then you have to pass an order. But when you pass an order, you cannot go back to the information suggesting income escaping assessment and say that since I have this information, I'll reopen. The answer is no. Once you make an inquiry, once you issue show cause, once you consider my reply, then you have to come to a conclusion that income has escaped assessment, and then only you can reopen. If in the course of reply, I have satisfied you that this is not a good question, this is not a case where income has escaped assessment, you cannot simply sidetrack my submission and merely basis the information suggesting income escaping assessment, you can reopen. So this is the how do we reconcile 148 explanation 1 with section 147. Now, as per explanation 2 to section 148, the following are the cases where it shall be deemed that AO has information which suggests that income has escaped assessment. What are the cases? A search has taken place under section 142, or a requisition has been made under section 132A after 1421. So if a search has taken place after 1421, then it is a deemed case of information suggesting income escaping assessment. Second case is if a survey has been conducted under section 133A of the Income Tax Act after 1420. So not only search, even survey is said to be a case where it is deemed that information is suggesting income escaping assessment. And the last two cases are cases where AO is satisfied with the prior approval of principal commissioner or commissioner that either any money, bullion, jewelry, or other valuable article or thing seized or acquisition belong to the other person, or any books of accounts, documents seized or acquisition in case of any other person pertain to, or any information contained therein relate to the assessee. So this is similar to your 153C, which used to exist prior to the 1421. So what are the three cases? A, search cases, which was earlier governed by 153A, or requisition cases, which were earlier governed by 153A. Two, your 153C cases where either the assets belong to you or the documents seized or requisition pertain to or information contained therein relate to the assessee. And C, where a survey has been conducted. Then in such cases, it is deemed that AO has information which suggests that income escaping assessment. Before going into anything else, let us just compare explanation 1 with explanation 2. Explanation 1 is, these are the information which suggests that income has escaped assessment. And explanation 2 is, in such situation, it shall be deemed that income has escaped assessment. Having gone through the orders passed under 148 AD in number of cases, we are of the opinion that the department believes once you have an information suggesting income escaping assessment, that is the end of the matter. You please comply in the reassessment proceedings. You cannot challenge the 148 proceedings. Because once there is an information suggesting income escaping assessment, I can reopen the assessment. When I compare explanation 2 to explanation 1, there is a deeming fiction in explanation 2 that in this case it is deemed to be a case where income has escaped assessment, or there is an information which suggests that income has escaped assessment. Whereas this deeming fiction is missing in explanation 1, which means if you have reopened a case as per the information contained in explanation 1, then in that case, the information should actually suggest that income has escaped assessment. You cannot simply say, inside portal, this information I will reopen. The answer is no. It is not stated in explanation 1 that it is deemed to be a case where income has escaped assessment. The answer is no. What they write is, this is the information which suggests income has escaped assessment, but you can reopen only if income has really escaped assessment. So this is the first point which also supports our case in respect of explanation 1. Now coming to explanation 2, earlier when they brought in section 148 explanation 2, in case of a search 153A proceeding, or in case of survey 133A proceedings, or in case of a third party 153C proceedings, they could have reopened your case under the new section 147 only in respect of 3 years, in respect of which it was deemed that income suggesting there is an information which suggests that income has escaped assessment. So earlier the deeming fiction was only restricted to 3 years prior to the date of search. However, they have now smartly removed the word 3 years, which means if there is a search in your case, or if there is a survey in your case, or if you are covered by 153C, as per explanation 2, it will be deemed that AO has information suggesting income escaping assessment in respect of all prior years till which they can go, 10 years or 6 years or whatever. So this, as we see normally in Income Tax Act, they start the provisions with A, with a very noble cause that we want to reduce litigation, we want to reduce controversies. This is how it will help the assessees. And slowly, when we go to year 2, year 3, year 4, A becomes A plus B, third year it will become A plus B plus C, and sometimes A will become A into A into B, A into C. So they'll keep on increasing or keep on widening the scope of section 148, forgetting what was the original intention behind making the amendment. And this is a classic case where the deeming fiction operated only for the first, the 3 years preceding the year of search or survey. Now they have gone up to 10 years. The old controversy which we had under the 153 or 153C proceeding about abated and unabated assessment and incriminating material, that will no longer survive under the new section 147. In fact, I am told that the Supreme Court has already heard the matter of incriminating material and unabated assessments, and it appears that it will not even survive in the old 153 and 153C proceedings. Be that as it may, we proceed further. Mind you, explanation 2 says it's a deemed information which suggests income as escape assessment. That does not mean that you don't have to fulfill the conditions of section 149(1)(b). Even for the purpose of section 149(1)(b), you will still need to satisfy the condition of having in possession books of accounts, documents, or evidence which should reveal that income of more than 50 lakhs is escaped. So yes, you have an information suggesting income escaping assessment, but if you want to go beyond 3 years, you still have to qualify the conditions of section 149(1)(b) of the income tax. Coming to 153C cases. Now 153C cases, that is clause 3 and clause 4 of explanation 2. There is one more jurisdictional requirement which has been added, which is assessing officer is satisfied with the prior approval of principal commissioner or commissioner that any money, bullion, jewelry belong to the SSC, or assessing officer is satisfied with the prior approval of principal commissioner or commissioner that any books of accounts, documents, seized or requisition in case of any other person pertain to or information contained therein relate to the SSC. So there are two conditions which one will have to fulfill to fall in clause 3 and 4. Assessing officer of the assessee, not of the third party, not of the searched party, but the assessing officer of the assessee has to record a satisfaction. And such satisfaction has to be recorded with the prior approval of principal commissioner or commissioner. If these two conditions are not fulfilled, then in that case, of course, you can argue that the proceedings are bad in law. So therefore, in 153C case, you will have two approvals. One is satisfaction will require an approval, and one is 148 notice will require an approval. Satisfaction will require approval of principal commissioner. If the assessment has been reopened within 3 years, you require approval under 151 of the principal commissioner. But if you reopen beyond 3 years, for those years, you will require approval of either principal chief commissioner or the chief commissioner. Now, again, there is one more point which one will have to take into consideration. Under 153C, satisfaction had to be recorded by the AO of the search party that this belongs to third party. And he will transfer the material to the AO of the third party. And then the AO of the third party had to record a satisfaction that this will have a bearing on the determination of total income of such other person. Now that satisfaction is now no longer present in explanation 2, clause 3 and 4. Therefore, does that mean that mere belonging of the asset to a third party or mere finding of documents, the information contained therein or relate to the third party, you can reopen irrespective of the fact whether any income has escaped assessment or not? Answer in my humble submission has to be no, because this again says that there is an information suggesting income escaping assessment. But to reopen under 147, you will still have to give a conclusion that income has really escaped an assessment. Please read explanation 2 starting point. It says, for the purposes of this section, it is only for the purpose of section 148. It is not for the purpose of section 147. And therefore, this may be a starting point, but mere finding of an asset in the premises of a searched party, which belongs to a third party, you cannot reopen the assessment of the third party unless there is an income which has escaped assessment. Now, there is one more controversy which I'll highlight very briefly here. This type of cases have started coming up since last 2 or 3 years. And in fact, the high courts have also granted stay. If there is a search in case of X party, some material has been found or some statement has been recorded in case of X party, that material or information has been forwarded by the AO of that party to the AO of third party. And now AO of third party issues notice under section 147 of the 148 of the Income Tax Act. We have taken arguments that in such type of cases, you cannot reopen under 147, but you could have only reopened under section 153C of the Income Tax Act, because this is a case where you have found something in the course of search in case of search party. The information contained therein relate to or pertain to third party. And as per your own satisfaction, this has a bearing on determination of total income. And therefore, what you can do is to initiate proceeding under 153C, because 153 starts with notwithstanding anything contained in section 147. For 153C will override 147. Please reopen under 153C and not under section 147. The tribunals have consistently held that yes, if it is pursuant to search and seized material have been received by the AO of the third party, assessment can be reopened only under 153C and not under section 157. Similar analogy will follow here. If your assessment is sought to be reopened based on the information found or documents found in the course of search in case of a search party after 1421, then according to me, it will be a case of explanation 2 and not explanation 1. As a result, in such type of cases, AO will have to record a satisfaction with the prior approval of commissioner. Plus, there is no requirement to issue any proceedings under 148A of the Income Tax Act. If these two conditions are not fulfilled, and if your assessment has been reopened based on any information found in the course of search in case of a search party, then in that case, you can very well argue that the proceedings are bad in law because you have not followed the jurisdiction required. So, if your assessment has been reopened based on information received from the AO of the search party, then you cannot say that I am also covered by explanation 1 because this is the information coming out on the inside portal, as well as I also fall in explanation 2 because AO is satisfied with the prior approval principal commissioner or commissioner. It has to be either explanation 1 or explanation 2. Since explanation 2 is more specific, dealing with documents found in the course of search and information contained therein relating to the assessee, my personal view is, if it's a case of information found in the course of search in case of third party, then they have to mandatorily follow explanation 2. And if they don't record a satisfaction with the prior approval of the commissioner, the entire proceeding should go. With this, some of the case laws which have come in context of section 148. The Delhi High Court in case of Blackstone Capital Partners has held that it was a case where assessee had received share application or share capital money. AO reopened the assessment. Assessee argued this is a transaction on capital account. There is no income escaping assessee. That objections were not disposed of or not properly considered by the assessing officer. Therefore, the court remanded the matter back to the assessing officer, but with a specific direction that transaction in issue is a capital account transaction and that no income whatsoever chargeable to tax is accrued or accrues or rises in India. This contention of the petitioner will have to be dealt with by the AO. Meaning thereby, today I can argue that if there is no income which has escaped assessment, if I can show that to the court, then in that case, assessment cannot be reopened. Similar is the finding of the Madras High Court in case of Dr. Matthew Cherian, which I will consider later on. Second, we have two Delhi High Court judgments in context of wrong information. If an information has been received on the inside portal, which pertains to another entity or that information is incorrect, and if I write in the response to show cause notice that this information is incorrect, does not pertain to me, still he reopens the assessment based on the same information, then the courts have quashed the information, quashed the reassessment proceedings and held the notices and the order to be bad in law. In fact, they write that in such type of cases, you have to consider to make a prior inquiry, you have to find out whether really the information pertains to the assessee. Since no independent inquiry is done and simply reliance is placed on the information received, therefore, on the basis of such information, the reassessment proceedings cannot be started. So there are two Delhi High Court judgments where, again, based on wrong information and simply relying on such wrong information, if assessment has been reopened, then in that case, courts have caused the reassessment proceeding. At this stage, let me just emphasize that all the propositions which we had under the old law are slowly getting approval of the courts under the new law. So we get an approval of the court that for reopening under 147, there has to be an income which is escaped assessment, which you find in Delhi High Court Blackstone. Similarly, we get the court's approval that if it's a wrong information or AO has simply not applied his mind and conducted any independent inquiry and simply relied upon the information of CGST authorities or the other authorities, then the assessment cannot be reopened. So slowly we are getting the approval of the courts in respect of the judgments under the old law. The third issue is the notice under section 148 is an unsigned notice. We have very recently a Bombay High Court judgment in case of Prakash Krishnavatar Bhardwaj. The notice was not signed manually or digitally. The court held that Section 282A requires the notice to be signed. Since it was not signed, the proceedings are bad in law. Similar conclusion has been given by the Allahabad High Court in case of Dauji Abhushan Bandar and Vikas Gupta, 444 ITR and 448 ITR. So therefore, if the notice is unsigned, either digitally or manually, it's not signed digitally or manually, then the proceedings are bad in law. This one Delhi High Court judgment in case of Sumanjit Agarwal, 449 ITR 517. They have dealt with all the procedural issues of issue of notice and date of dispatch. On the aspect of signing of notice, mind you, on the aspect of signing on notice, Delhi High Court has ruled against the SSE. They say that as per Section 282A, read with Rule 127A, there is no requirement of signing the notice, and mere writing of the name and designation of the AO and sending the email from the email address of the AO, designated email of the address of the AO, will suffice, and there is no need to sign the notice. My humble opinion is that this judgment is not correct. The Section 282A categorically says it shall be signed and served either physically or in like electronic manner. Once they use the word sign, which the word conjunctive word and, according to me, there is no option with the department not to sign it. It has to be signed. A number of circulars and instructions in this regard. Furthermore, the consequences of this is that anybody can issue notice. The inspector or the other officer of the ITO can issue notice. How to verify it's a correct notice issued by the AO is once it is signed by the AO, it will be appear to be a correct notice or a valid notice. So therefore, this judgment, according to me, should not apply in case of signature. We already have Delhi and we already have Bombay and Allahabad High Court judgment. Apart from this issue, on the other issues, it is with the SSE in this fashion. Mere uploading the notice on the portal, not sending email, not sending real-time alert. Mere uploading the notice on the portal is not a valid service of notice, and therefore, in that cases, notices are bad in law. However, at the same time, they say that once it is uploaded on the portal, if the SSE will open the portal, SSE will verify the notice. The date on which SSE used the notice, which information is available with the department, that on which date you have opened your portal and viewed the notice, that shall be considered as a date on which the notice has been served to you. With due respect, the first part is correct. If it is not sent on email, or if it is not received by way of a real-time alert or not sent physically, you don't fulfill the requirements of Section 282, read with Rule 127, therefore it's bad in law. Mere fact that I have subsequently seen the notice does not mean the notice has been served validly. Therefore, one can take this argument. The third argument is mere generation of notice on the ITBA screen cannot in fact or law amount to issue of notice. These were the cases where notice was generated on 31st of March, but it was sent by way of email after 31st of March. So courts have held that if the email itself has been sent on 1st of April, that means notice has been issued on 1st of April. Mere generation of notice on the ITBA portal does not amount to issuance of notice. And in such case, the date and time of dispatch as appearing on the ITBA system would be considered as a date on which notice has been issued. Further, the court also held that notices which have been sent by way of email on unrelated email addresses, the email addresses on which they have to send notices, have been prescribed in Rule 127A. If they send email on any email address other than the email address specified in Rule 127A, then in that case, court has held that it's not a valid service of or issue of notice. So these are some of the issues in respect of notice of issue of notice and dispatch of notice. At the same time, we also have judgments that if notice has been issued in the name of deceased assessee, the notice is bad in law. Plus, the notice is issued in the name of a non-existent person after amalgamation, the same is also bad in law. So these propositions which were there under the old law still continues. There is no change. Yes, now we come to the judgment of the Madras High Court in case of Dr. Matthew Cherian and others versus ACIT. So we have discussed in context of information suggesting income escaping assessment that is a starting point. You conduct inquiry, you issue show cause, you consider the reply. Then you have to form a belief that income has escaped assessment. Mere reliance on information suggesting income escaping assessment is not sufficient. So this is that case where the Honorable Madras High Court has held that not all information in possession of the officer can be construed as information that qualifies for initiation of proceeding for reassessment, and it is only such information that suggests escapement and which, based upon material in his possession, that the officer decides as fit to trigger reassessment, that would qualify. The information in possession of department must prima facie satisfy the requirement of enabling a suggestion of escapement of income. This is not to say that sufficiency or adequacy of the information must be tested, as such an analysis would be beyond the scope of jurisdiction of the court and writ jurisdiction. However, whether at all the information gathered could lead to suggestion of escapement of tax can certainly be asserted. With the necessity for belief effaced from the statutory provisions, a dimension of subjectivity stands substantially withheld. In the present regime of reassessment, AO must be able to establish proper nexus of information in his possession with probable escapement of tax. No doubt the term used is suggest. That is not to say that any information, however tenuous, would suffice in this regard, and it is necessary that the information has a live and robust link with the alleged escapement. This is where settled propositions assume relevance and importance. In effect, the concept of live link and nexus still is relevant in the context of new assessment regime, because even explanation 1 or explanation 2 requires you to have an information which should suggest that income has escaped assessment. According to me, suggest and belief are not that great different. They don't have that great different meaning. And therefore, the Madras High Court has held that there still has to be a live link or robust link of the information with the alleged escapement. Mere information will not allow you to reopen. It should also lead to escapement of income, or at least a prima facie belief that income has escaped assessment. At the same time, the Calcutta High Court and Delhi High Court has also echoed the same sentiments. They say that the term information in explanation 1 under section 140 cannot be lightly resorted to reopen the assessment, and this information cannot be a ground to give unbridled power to the revenue. So this is what Calcutta High Court held, and the Delhi High Court in case of Divya Capital has held that whether it is information to suggest under the amended law or reason to believe under the erstwhile law, the benchmark of income escaping assessment still remains the primary condition to be satisfied before invoking powers under 147 of the Act. Really, no great purpose has been served by amending the entire reassessment provisions. We are back to square one. Now we come to section 148A of the Income Tax Act, which is what the Supreme Court says in the judgment of Ashish Agarwal, that it is in the nature of game changer. At the same time, the Bombay High Court, the Rajasthan High Court, the Delhi High Court have held that section 148A is nothing but statutory embodiment of the jurisdictional requirements prescribed in the judgment of Supreme Court in case of GK and Driveshaft. So there he formed a reason, reopened the assessment, you file a return, you ask for reasons, object, he has to pass an order disposing of objections. Same thing happens in 148, but the same thing happens before the issue of notice under 148. That means the AO has still have a chance to rectify his mistake or to correct his mistake and not to reopen this. So here again, section says you conduct your inquiry first, if required, of course, if required, but subsequently the department has come out with circulars that all the information is not correct. The information have their natural inherent defect of being wrong. In the few, please verify the information. 2, issue a show cause as to why assessment should not be reopened with some statutory time limits given. I file a reply. Please consider the reply and pass an order within some period prescribed under section 148 AD of the Act, whether it's a fit case or not to reopen an assessment. However, in some of the cases, there is no need to follow the procedures under section 148 of the Act. And again, the specified authority for the purpose of section 148A is the one specified in 151. Now, under proviso to 148A, they say that in the 4 situations, there is no necessity to follow 148A proceedings. there is no necessity to follow 148A procedures. However, without noticing this distinction, Supreme Court in case of Ashish Agarwal has held that it is mandatory to follow 148A because they have used the word shall. It's a condition precedent. It's a game changer. Now, Supreme Court in its judgment has reproduced the entire section 148, 148, everything. Does that mean that even in cases as covered by proviso to section 148A, they will have to follow the procedure under section 148A? Somebody will have to test that, but one can always try arguing this before the court. Nobody can dispute that Supreme Court was not conscious of the proviso to 148. Despite that, if the Supreme Court says it's a game changer condition precedent, and according to me, even in cases covered by proviso to section 148A, they will have to follow 148A provisions. At the same time, prior approval of authority has been prescribed under each step, including conducting inquiry and passing of order. Earlier, it was a requirement even for before issuing of show cause notice under section 148AB, but now that has been removed. The requirement of section 148A is you have to issue a show cause as to why notice should not be issued on the basis of information which suggests that income chargeable tax escape assessment and the results of inquiry conducted. Meaning thereby, the show cause should specify what are the points which I have to deal with. At the same time, your show cause should be accompanied by the relevant information material in your possession for me to deal with the same. This is now a settled law. Supreme Court in case of Ashish Agarwal has held so. As well as the department has issued a circular on 1st of August 2022, and they have clarified that all material in your possession, please give to the assessee to reply. Time to reply is 7 days. Now, sometimes what happens, they issue a notice under 148AB, but it is not accompanied by the material. So therefore, you file a reply, boss, you give me the material. I'm not able to reply properly. Then they issue another notice giving you the material, but then they say reply within 2 days or 3 days time. Now, this according to me is not correct. Instruction number 1 of 2022, which was of course issued pursuant to Ashish Agarwal judgment, clearly held that period of limitation for reply, 2 weeks time, and in that case, will be counted from the last date on which material has been provided. So if your 148AB notice is not accompanied by the material, then that is not a 148AB notice per se. And subsequently, if the material has been provided, the minimum time period of 7 days has to be counted from the date on which material has been provided. So say, for example, notice on 23rd of March asking to reply within 7 days. On the 7th day, you write that, boss, you're not giving me material, please provide the material. In 2 days, he provides you material saying, on 1st of April, he provides you material. He says, you reply by 3rd of April, otherwise I'll pass the order. You don't reply by 3rd of April, he passes the order on 4th of April. Here I can take a ground that you have not provided the minimum time period of 7 days because that has to be counted from the date of provision of the material. Since you have not followed 148AB provisions, the entire proceedings are bad in law. Opportunity of being hearing should be given. It should not be by way of just written submission. And you have to pass an order in writing where it is a fit case, and you have to deal with all my contentions. All the criteria, all the contentions have to be considered. This has also been specified in circular number 1/8/2022, where they say that it has to be a speaking order, detailed order, reasoned order, dealing with all the contentions of the assessment. Now, 148A order is not an appealable order, and therefore you can file a writ. In fact, the Supreme Court, Bombay High Court, Rajasthan High Court have tacitly accepted that GK and drive shaft is now 148A. And if against the order disposing of objections pursuant to GK and drive shaft, if you can file a writ, you can certainly file a writ against 148AD order. You can certainly not file a 264 because the order is passed with the approval of PCCIT and PCCIT or PCIT or CCIT. Can you file an appeal under section 246A? Because Supreme Court in case of Genpact India has held that in any case where you deny your liability to assess under the Act, you can file an appeal, irrespective of section 246A making a specific provision for 148AD order. Technically, you can file an appeal, but I have my doubts because A, there's no specific section. B, order is passed with the approval of principal commissioner, principal chief commissioner, or chief commissioner, and therefore the commissioner of income tax appeal, who is subordinate to all three officers, he, I don't think so, will be in a position to say that, no, once they have approved, I cannot go beyond that. So, on the grounds of superiority, also, he will not be able to dispose of the appeal. Third, if you file an appeal, you will not be able to get a stay on the notice To get a stay on the notice, writ is a better option. And you can challenge on various jurisdictional issues. Now, earlier I was of the opinion that your 148A(d) order will now replace reasons to believe, and which cannot be improved upon, has been held by Bombay High Court in case of Hindustan Unilever. But now I have realized that, having considered the judgments of various high courts, that show cause notice under section 148A(b) is the reasons recorded which cannot be improved upon in 148A(d) order. That is what the courts have held, and we will deal with those judgments. Therefore, this judgment of Hindustan Unilever Bombay High Court, where it held that you cannot improve upon the reasons, is still continuing in a different form, but it is still continuing. And therefore, one can argue that if your show cause notice is on A issue, I reply, you are satisfied, you drop that, you reopen on B issue, not possible. That is 2. There's one more argument which we have not taken before the Bombay High Court and the other high courts, that under 151A, which deals with faceless reassessment proceedings, they have issued a notification number 18 of 2022 dated 29th of March 22, wherein they say that even issuance of notice under section 148 will be based on automated allocation system in a faceless manner. And therefore, relying upon that notification, we say that jurisdictional assessing officer does not have any authority to issue notice under 148. It has to be done in a faceless manner by under section 151A. This appears to be a reasonably good argument. Department, I think, have not been able to digest this argument, or they have not been able to understand what is the consequence of this argument. What are the exceptions as considered by the proviso to section 148A? Of course, we have discussed that Supreme Court does not consider the exceptions, and they say in all cases 148A to be issued. Let us go through the exceptions. Search cases after 1421. 153C cases where AO has recorded satisfaction. In these two cases, there is no need to follow 148A proceedings. They also made one more adjustment or one more exception, which is where assessing officer has received any information under scheme notified under section 135A pertaining to income chargeable to tax escaping assessment for any assessment in case of the SEC. If I compare this you can relate to clause 4 of explanation 1 to section 140. Information suggesting income escaping assessment means any information made available to the AO under scheme notified under section 135A. Then you can reopen. This is the information suggesting income escaping assessment. But under clause D2 proviso, it says that assessing officer has received any information in the scheme notified under section 135A pertaining to income chargeable to tax escaping assessment for any assessment here. Mere receipt of information is not sufficient under 135A, but that information should suggest or it should pertain to income chargeable to tax escaping assessment. Then only no inquiry is required to be made under 148A of the Act. My humble submission is that this proviso, this clause D has to be challenged. Your information is not always correct, and therefore just because you received information from some party does not mean you will blindly follow that information and issue notice under section 148 without following 148A provisions. So this has to go. Somebody will have to make a representation that clause D has to be removed. I can understand that search cases and 153C cases you don't want to start and you don't directly want to start the reassessment proceedings, but not in the case where you receive information under 135A. Also, mind you, most importantly, though in case of a survey after 1421, the AO will be deemed to have information suggesting income escaping assessment, but he still has to necessarily follow 148A provisions. He'll have to issue you a show cause and has to file. You have to file a reply, and he'll have to still pass an order of 148A. Therefore, in a survey proceeding, despite deemed information, 148A procedures have to be followed, which proves my point that explanation 2 or explanation 1 are not sacrosanct. After having received information suggesting income escaping assessment, you still have to follow or come to a conclusion that income has escaped assessment, and then only you assume jurisdiction under 147 to complete the assessment. Now, very interestingly, some of the case laws in this area. My personal belief, Supreme Court in case of Ashish Agarwal has held that it's a 148A is a condition precedent, which means it's a jurisdictional section. It's in the nature of game changer is what Supreme Court says. 148A is a jurisdictional section, and therefore, if you don't follow 148A provisions, then according to me, it's a case where proceedings have to be quashed per se. There is no question of set aside. Now, in this respect, we have some jurisdictional, we have some judgments to this effect. Very recently, Bombay High Court in case of Anurag Gupta has held that 148AB requires you to not only issue a show cause but also provide requisite material to the SSC. Since you have not provided requisite material to the SSC, you have violated the procedures prescribed under section 148AB, and therefore the assessment proceedings are quashed and set aside, not remanded back. Then we also have Bombay High Court judgment in case of Chitra Supekar, which held that the notice under section 148 clause B, the show cause notice under 148 clause B was served on the old address. Since the requirement to follow 148A provisions is a jurisdictional procedure, and since you have not followed by issuing proper notice, entire proceedings have been held to be bad in law. Then we have a Kerala High Court judgment. Surprisingly, even Kerala is in favor of the SSC, that you have received a notice, you filed a reply, but he passes an order. I'm sorry, this is a different case. This is a case where he issued a notice under 148A, what the AO claims, but I was never served with that notice before 148 notice was issued. They say that since you have not served the 148 notice, you have no proof that 148AB notice has been served before issue of 148 notice. Therefore, you have not followed 148 proceedings, 148A procedures, and therefore the entire proceedings are bad in law. Mind you, in this Kerala High Court judgment, there was a specific argument taken by the department that please allow us to issue a fresh notice. High Court says you have not followed the jurisdictional requirements. We allow the writ petition. You may do whatever you want to do as per law, which means the notice and the proceedings have been quashed. We have a Bombay High Court judgment in case of Samada Corporation where time limit to give reply in response to 148 notice was only 3 days. And since the minimum time prescribed was 7 days, the Bombay High Court has held that you have not followed 148A provisions, therefore entire proceedings are bad in law. Similar view was taken by Jharkhand High Court in Jindal Forgings. The time limit given to reply was only 3 days. Here the department argued that, no, but we have passed the orders on the expiry of 7 days. That is not material. They say you have to give 7 days. Since you have not given, you have not followed jurisdictional provisions, and therefore the proceedings are bad in law. Again, a Bombay High Court judgment in case of Agricultural Produce Market Committee where issue notice, I filed a reply. You did not even consider my reply and pass the order. Since you have not considered the reply, and in the impugn order, you write that the petitioner has failed to submit its explanation. Though on the portal, there is an acknowledgement which shows I have submitted the explanation. Court held that since you have not followed the procedures of section 148A of the Act, therefore, the order under section 148AD and the notice under section 148 have been quashed and set aside. We also have cases where the 148AB show cause notice has been issued in the name of a deceased person. Courts have held that though subsequent 148 notice and 148 AD order have been passed in the name of the correct person, but since the show cause has been issued in the name of deceased person, entire proceeding goes. We have Bombay High Court judgment and Gujarat High Court. At the same time, let us not be very optimistic. There are equal number of judgments wherein the courts have sent back the matter to the assessing officer wherever procedures of 148A have not been followed. So if you have not dealt with the objections or not dealt with the submission, or if the material has not been supplied, or if the personal hearing has not been granted, in such cases, the courts have set aside the matter to the AO to carry out de novo exercise. Now, I have just one point to make. Suppose your assessment has been reopened within 3 years, but they have not followed 148A procedures. You file a writ. High Court quashes the assessment order, the 148 AD order and the 148 notice. But they can still reopen subject to 149 1B time conditions of beyond 3 years, 50 lakh and other conditions. Take a case where instead of quashing the order, they remand it back to the AO. You do it afresh after giving fresh opportunity. And now the AO will pass an order under 148 AD. When the AO passes an order under 148 AD of the Act, it is certainly beyond 3 years. And therefore, again, I can argue that you have to follow the conditions of 149 1B. Since you have not followed 149 1B conditions, less than 50 lakhs or whatever it is, just because it has been set aside to you to do it afresh does not mean it will come within the ambit of 3 years. Today, when you pass the order, it is beyond 3 years, and therefore you have to follow 149 1B condition. Really speaking, quashing or set aside within 3 years will not make much difference, because ultimately, at the time when he passes the fresh order, you have to see whether it is beyond 3 years or within 3 years. And if it is beyond 3 years, we still will have to fulfill the conditions of 149 1B of the Act. What in case where it has been issued, say for example, at the expiry of 10 years, not followed 148A, I go to High Court, High Court says cost and set aside, remanded to the AO. At that point of time, I will have to make myself clear that you pass an order as per law, and I will have all my contentions open, including limitation. That certainly the High Court will have to do, because High Court cannot extend the period by which an AO has to pass an order under 148 AD of the Act in a jurisdiction. They can remand the matter, but still the limitation will still apply. On the aspect of alternate remedy, earlier Supreme Court in case of Anshul Jain held that once the procedures of 148 AB have been followed, then the High Court cannot consider on the merits of the case. At the same time, Supreme Court in case of Red Chilies have held that no, you cannot simply say that writ is not maintainable, because there are so many judgments under the old law which will have to be required to be examined by the High Court in depth, and therefore simply on the basis of alternate remedy you cannot. In fact, I personally feel 8 AD is not an appealable order. 148 notice issued is subject to jurisdictional satisfaction, jurisdictional requirements to be fulfilled. And 3, 148A provisions are nothing but statutory embodiment of the judgment of Supreme Court in case of GK. And therefore, by virtue of all 3 issues, I can file a writ petition and challenge the judgments. In fact, we have seen judgments of various high courts entertaining writ petitions. Most importantly, we have judgments to the effect that you issue show cause notice on A ground, you cannot pass an order on B ground or an improved A ground also. If you do that, it's clearly bad in law. Chhattisgarh High Court has held that you cannot travel beyond the show cause notice, and they have relied upon the judgment of the Supreme Court under the Indirect Taxes, Customs, Commissioner of Customs versus Toyo Engineering. The Supreme Court held that department cannot travel beyond a show cause notice. The Delhi High Court in case of Catchy Prop Bill held that you reopened on A ground. You never asked the SSC to explain the source of fund. Now you pass an order that you have not explained this. It has to be held to be bad in law. Similar view has been taken by Delhi High Court, Usha Rani Girdhar, and Calcutta High Court in Excel Commodities and Derivatives. In fact, in Excel Commodity Derivatives, AO made some allegations. SSC replied, no, this is not correct. AO accepts that in the order and reopens on some other issue. The single judge of the Calcutta High Court held that, okay, I'll remand it back to the assessing officer, do it afresh, provide him opportunity. SSC filed an intra-court appeal. The specific question before the High Court was, can in such case you remand it back or you have to quash? High Court says, you cannot pass an order on some other grounds. Therefore, there is no question of remanding back to the AO in such type of cases. And therefore, I will say that Hindustan Unilever 268 ITR 332, which says that you cannot improve upon the reasons, still continues more forcefully, and you cannot improve upon the show cause notice, is now what the courts have held. A very interesting decision of Rajasthan High Court in case of Abdul Majid 447 ITR 698, wherein they have held that you have to pass an order under 148 AD and you have to issue notice under section 148 only based on material available on record. You cannot consider any extraneous material. So this was a case where department says that there are certain cash deposits, I will reopen. This was beyond 3 years. SSC says, okay, cash deposits are only 19,39,000. AO says, no, but this is only one account. There might be some other account, and therefore income of more than 50 lakh as escape process. High Court says that you don't have any material to show that SSC was having any other account or there was a cash deposit in such account, except for 19,39,000. Since it is less than 50 lakhs, it has to be quashed. You have to restrict yourself to the material available on record. If I don't take this view, then it will open a floodgate And even without availability of any material, authority would be initiating proceeding under 148 of the Act, which will completely frustrate the object of incorporation of 148. So you restrict yourself to what has been stated in show cause and the material available on record. You cannot go beyond that. This takes me to the next section, section 149. This again is a game changer section. Here, time limits have been prescribed to reopen the assessment. You cannot reopen if you have crossed 3 years time limit. Within 3 years, you can reopen, provided you fulfill the earlier conditions. But if you want to reopen beyond 3 years, up to 10 years, then in that case, you have to satisfy some other conditions like AO has to be in possession of books of accounts, documents, or evidence, which should reveal that income has escaped assessment, either represented in the form of asset or expenditure in respect of a transaction, or entries in the books of account. And such escapement should be more than 50 lakhs. First proviso states that if a notice could not have been issued at a point of time under the old law because it was beyond 6 years, then that notice cannot be even issued under new law in respect of assessment years on or before 1st April 21. So assessment years AY 21-22 and prior assessment years, if they cannot reopen under the old law, then they cannot reopen under the new law. Second proviso states that this provision of this subsection shall not apply in case of notice under section 153A or 153C, read with section 153A, is required to be issued in respect of a search initiated before 31st day of March 21. The new two provisos have been issued to give certain extra time limit in case where search has been conducted after 15th of March, and the time period has the time limit is expiring for issue of notice in respect of any year. Now been recently introduced. The fifth proviso after this amendment excludes the time period given to the assessee to file reply and period during which the proceedings under 148 have been stayed to be excluded for calculating the period of limitation for issuing notice under 148. Same goes with explanation 6 sixth proviso, which deals with limitation for passing order under section 148 AD. They've also defined the word asset in an inclusive manner. Subsection 1A was inserted with from 1422, which says that this is the income escaping assessment in the form of asset or expenditure, but it is spread over a period of 2 to 3 years and combined together exceeds 50 lakhs. Then you can reopen all 3 years, irrespective of the fact that in 1 year, the threshold of 50 lakh has not been satisfied. Now, coming to the issues, within 3 years, no doubt, above 3 years. First requirement, AO has to be in possession of books of accounts, documents, or evidence. They have used the word books of accounts, documents, or evidence. Please contrast this with explanation 1 to section 148, where they have used the word information suggesting income escaping assessment. The legislature has consciously not used the word information in 149(1)(b), which means for crossing the threshold of 149(1)(b), it has to be something more than the information suggesting income escaping assessment. Mere information from investigation wing or mere information from some other officer that in case of your assessee this has happened, they cannot reopen the assessment. There has to be something more than that, which has to be actual evidences like statement or intimating. Letter or information on the inside portal will not be sufficient. This necessarily has to be a new tangible material. Beyond 3 years, you have to be in possession of books of accounts, documents, or evidence. This has to be a new tangible material. For the first time, the statute has used the word evidence. And therefore, according to me, the books of accounts, the term books of account or other documents should take color from the word evidence. And therefore, even the books of accounts or other documents should be in the nature of evidence, which should reveal that income has escaped assessment. Now, this is the first threshold. The second threshold is they have used the word, it should reveal that income has escaped assessment. Now, reveal word is much more stronger than the word belief, reason to believe. It is much more stronger than the word suggesting income escaping assessment. These documents should reveal, it should conclusively give evidence of the fact that income has escaped assessment. Therefore, within 3 years, information suggesting income escaping assessment, but beyond 3 years, there should be a conclusive evidence which should reveal that income has escaped assessment. So I am placing reliance on the word evidence. I am placing reliance on the word reveal to drive home the point that it's a much strict requirement as compared to all earlier sections and the sections under the amended act. And please keep in mind the distinction between information and books of accounts, documents, or evidence. Now, such income should be represented in the form of asset, or it should be represented in the form of expenditure or any entry or entries in the books of account. Asset has been defined to include immovable property being land or building or both, shares, securities, loans, advances. Cash deposit in bank account will constitute asset. True. But it should at the same time also reveal income escaping assessment. We have judgments of the Bombay High Court, we have judgments of various tribunals to the effect that mere deposit of cash in the bank account does not mean income as escape assessment. So therefore, though it crosses the threshold of income of representing in the form of asset, but mere deposit of cash in the bank account does not lead to any belief or does not reveal that income as escape assessment. Asset, of course, will not include unsecured loan or share application money because it's a liability. And therefore, they have introduced the other two items, which is expenditure in respect of transaction or entry or entries in the books of account. At the same time, also compare the wordings of 149(1)(b) versus the 149 subsection 1A, which has been introduced. 149(1)(b) says income represented in the form of asset, and 149(1)(a) says that tax represented in the form of asset or expenditure, and the investment in such asset is made in more than 1 year. So therefore, really, 149(1)(b), income represented in the form of asset should be in the nature of investment in the asset. One can draw this analogy. Coming to the second item, income represented in the form of expenditure in respect of transaction or in relation to an event or occasion. Now, these two words are actually not reconciling with each other. There cannot be any income escaping assessment which is represented in the form of expenditure. If it's an expense, it's an outgo, there is no income. And therefore, I would like to believe that this expenditure in respect of a transaction or event or occasion can be roped in to take care of any bogus expenditure, bogus purchases or bogus expenditure or expenditure of such kind. It cannot be something more than that. You cannot say that, no, you have claimed this as a revenue expenditure, this should have been taken as a capital expenditure. According to me, that is not the purpose of expenditure in respect of any transaction. Furthermore, they have only used the word expenditure, they have not used the word allowance. Allowance is different from expenditure. Third, income represented in the form of entry or entries in the books of account. Now, how can an income be represented in the form of entry or entries in the books of account? It should mean that the entry or entry in the books of account is a bogus entry. Not each and every entry in the books of account will constitute income escaping assessment. If that is the case, then the asset and expenditure part has becomes redundant. The finance minister, while introducing section 140, introducing the new sections, as well as the Supreme Court has held that beyond 3 years we have kept strict conditions. If it is strict conditions, then certainly it should not be a mere entry in the books of accounts. Any transaction represented in the form of entry in the books of account should not be covered by 149(1)(b). Income represented in the form of entry or entry in the books of account. Income should be represented. It should be represented in the form of entry or entry in the books of account. Should only cover accommodation entries and nothing more. That is my view. Of course, the courts will interpret this in future. Lastly, of course, this third item will apply only if you maintain books of accounts. If you don't maintain books of account, then the third item. Take a case where I have transferred a property for ₹1 crore. Stamp duty value is 2 crores. And therefore 1 crore has escaped assessment under section 50C. Such kind of deemed income will never get covered beyond 3 years. Because you have received 1 crore. There is no allegation you have received 2 crores. Therefore, there is no asset. There is no expenditure. And there is no entry in the books of account. So such type of deeming fiction, according to me, cannot be covered after 3 years. 149(1)(a), of course, we have discussed. This actually amounts to backtracking on the promise that you cannot reopen if it is more than 50 lakhs, but now you say you can reopen if such asset or expenditure is spread. Third proviso and fourth proviso says that time limit granted for the assessee to file reply has to be excluded in calculating the period of limitation. So that is something which is very depend upon the case to case. Fourth proviso really is not making any provision. We'll have to consider it, analyze in depth what is the fourth proviso, because fourth proviso extends the time limit to pass order. Time limit to pass order under 148 AD is 1 month from the end of the month in which reply is filed. That will never get less than 7 days, and therefore there is no question of extending it to 7 days. First proviso to section 149 is something which we'll have to deal with. Simply put, it states, if you cannot reopen at a particular point of time, if you cannot reopen a year under the old law, 149(1)(b) of the old law, then that very assessment year cannot be reopened under the new law. Therefore, 13, 14, 14, 15 become time bound on 31st March 20 and 31st March 21. You could not have reopened on 1st of April these 2 years, and therefore after 1st of April, you cannot reopen these assets. This is a table. Since the proviso applies only to assessment year 21, 22 and prior assessment years, under the old sections, these assessment year is time bound after 6 years, and therefore even under the new section, you can go beyond 3 years, however, subject to the time limit of 6 years as per the first proviso. A third, they are inserting a new proviso that if a search happens after 15th of March, and if there is a time limit expiring in respect of any assessment year, you will not be able to reopen that assessment. And therefore, they are granted additional 15 days time. And similar situation has been prescribed in case where a survey has taken or a statement has been recorded under 131 in consequence of any search. The fourth proviso is very restricted in its application because statement recorded or documents found under section 131 or 133A, which is in consequence of a search conducted after 15th March 22. And only in that case, they'll get an additional time of 15 days. In context of 149, very importantly, the Rajasthan High Court has held that in case of Abdul Majid, authority is required to reach satisfaction to not only that income chargeable to tax escape assessment, but in case where 3 years have elapsed from the end of the relevant assessment year, order under section 148A for issuance of notice could be passed if there were no statutory impediment as contained in section 149(1)(b) of the Act. I will compare this with Hindustan Unilever 268 ITR 332 that. There, the High Court held that under the old law to reopen, AO has to give a finding in the reasons recorded that there is a failure on the part of the assessee to disclose fully and truly all material facts, and what material facts have not been disclosed. If that allegation is not there, or if they have not mentioned what material facts have not been disclosed, 148 proceedings are bad in law. Of course, we have some contrary judgments that if otherwise I can decipher from the reasons recorded, then the assessment is still valid. Similarly, under the new law, if you go beyond 3 years, then there has to be necessarily a finding in 148 AD order that I am in possession of these books of accounts, documents, or evidence which reveal that income has escaped assessment. But after 3 years, if they merely write, I am in possession of information suggesting income escaping assessment, prima facie case has been made out. According to me, threshold of 149(1)(b) has not been fulfilled, and therefore the proceedings are bad in law. So I will compare 149(1)(b) with first proviso to section 147. There is a necessity to write in the order, you are in possession of what, which reveal that income has escaped assessment in the form of what? Asset, expense, or book entry. We also have a Karnataka High Court judgment in case of Azim Premji, where they have held that for the purpose of 149(1)(b), assessment cannot be reopened on the basis of very same information which was readily available with the AO when the original assessment order was passed. Which means we also now have a judgment to the effect that it has to be a new tangible material. That judgment again continues, that proposition again continues. More interestingly, the Karnataka High Court has held that for AY 13, 14, 14, 15, 4 years elapsed on 31st March 18 and 31st March 9, 31st March 17 and 31st March 18. Since all material facts were disclosed, you could not have reopened the assessment as per the first proviso after 31st March 17 and 31st March 18 as per the first proviso. If that be the case, you cannot reopen the assessment under the new law because it has already become barred under the old law. It's a very interesting proposition. Even for AI 15, 16 and 16, 17, we can take this argument that since 4 years have already elapsed under the old law, and there is no failure to disclose truly and fully all material facts, therefore you could not have reopened under the old law as per the first proviso. As a result, it has become barred by limitation under the old law, and the subsequent amendment, under the subsequent amendment which extends the time period, you cannot reopen. Similar judgments were there in the context of that 16 years foreign undisclosed asset, Delhi High Court Brahma Bhatt. That same logic can be applied even here also. Section 150 is similar to the old section, no change has been made. So we'll skip that for a moment. We'll come to 151, which is sanction for issuance of notice. Abhidan, I'll take 10 minutes more if it's okay.
Yeah, Dharan, please go ahead.
Thank you. Sanction under 151. Now, very typically worded section. Specified authority for the purpose of section 148 and section 148A shall be Principal Commissioner, Principal Director General, or Commissioner Director if 3 years or less than 3 years have elapsed. And Principal Chief Commissioner, Principal Director General, or where there is no Principal Chief Commissioner, Director General, and Chief Commissioner, Director General if more than 3 years have elapsed. Actually, 151 clause 1 should have worded that if less than 3 years have elapsed, then Principal Commissioner or Principal Director or Commissioner Director, and 2 should have said if more than 3 years elapsed. Now 1 also uses the word if 3 years have elapsed, then Principal Commissioner. If 3 years have already elapsed, then Principal Commissioner. The language problem, they have messed it up. There is also an amendment that for the purpose of calculating this 3 years period, the time excluded under section 149(1), third proviso and fourth proviso, which is now fifth and sixth proviso, also has to be excluded. Now, under the old section 149, they have used the word satisfied. Now we have used the word approved, but there is no difference. There has to be application of mind on the part of the approving authority, and mechanical satisfaction will not suffice. Even the Supreme Court has held in the Ashish Agarwal's case that at each and every state, there is a threshold prescribed for getting an approval, which means there has to be proper application of mind. At the same time, approval or sanction has to be of the proper authority. If it is of some other authority, then they are not supposed to be a valid approval. Now, this controversy is live before the Bombay High Court for assessment year 1890, 3 years elapsed on 31st March 20. They have issued show cause notice before 31st March 22 with the approval of Principal Commissioner of Income Tax. Very well, absolutely valid. It is within 3 years. But then when they passed the order, it was after 1st of April, say for example, 7th April, 15th April, etc. At that point of time, 3 years had elapsed, and therefore they had to take approval of Principal Chief Commissioner of Income Tax. But they rely upon the third proviso to section 149, which was then existing, which held that time limit given to file reply has to be excluded for the purpose of 149. Now that proviso only applies for the purpose of section 149. Therefore, time limit will be excluded for the purpose of 149, not for the purpose of section 151. And therefore, if the notice has been issued after 3 years, then in that case, approval of Principal Chief Commissioner is required to be taken. And this proposition has been accepted by the Bombay High Court in case of Chitra Supekar versus IPO. Now, they've amended the Finance Act. They have amended by Finance Act 2023. And now they say for the purpose of calculating 3 years period, the time given for the assessee to file reply will also be excluded. And so for now, they can say that even after the expiry of 3 years, we have taken the approval of Principal Commission, which is a valid approval. Secondly, we had taken an argument that in 151(2), approval necessarily has to be of Principal Chief Commissioner or Principal Director General. If you look at the speech of the Honorable Finance Minister, she had specifically stated, no, approval is of the topmost authority where ensuring adequate safeguards. In case of notices issued by Central Circle, we have seen that after 3 years, notices have been issued with the approval of Chief Commissioner of Income Tax Central. Though there is a Principal Chief Commissioner existing in Bombay, we have taken an argument before the court that you have to necessarily take approval of Principal Chief Commissioner or Principal Director General and you can go to Chief Commissioner or Director General only if there is no Principal Chief Commissioner Director General. This argument, of course, now they're going to amend it by Finance Act 2023, and they're going to remove where there is no Principal Chief Commissioner Director General, and therefore even the Principal Chief Commissioner is now not going to be burdened with the reassessment proceedings. Now even the Chief Commissioner can approve, but this shows how they are backtracking from their promises. The procedures now, of course, the procedures we need not discuss because I already discussed with later. This presentation will come to you. Only point which I want to highlight is in search case and in 153C cases, you are not going to be issued with 148A notices. You're not going to file your reply. There's a direct 148 notice. In such type of cases, according to me, still today, you can ask the department, please issue the reasons for reopening the assessment, because you still need to be in possession, or you still have to satisfy the threshold of 147 of the Income Tax Act, that income is escaped assessment. And in case of assessment beyond 3 years, you still have to fulfill the conditions of 149(1)(b), that is documents, evidence, books of account which shows income of more than 50 lakh. Therefore, though 148A provisions are not applicable, still, according to me, you can ask them, please show us what is the income which has escaped assessment, and you can reply to that and get an order disposing of objections, and you can still follow GK and drive shaft. Some of the old jurisdictional requirements which are done away with are reason to believe. But again, it has been brought back in the nature of information suggesting income escaping assessment. We have seen Madras High Court, more than 4 years failure on the part of the SSC, and foreign assets reopening up to 6 years. Some of the old jurisdictional requirement which will still continue, according to me, is change of opinion. There has to be an income escaping assessment. Notice has to be issued by jurisdictional AO. Here, of course, one can also consider faceless assessing officer, where you cannot reopen for making verification or making fishing roving inquiries. This will apply with much more force, because even after you have received my reply in response to show cause, you pass an order, and if you still want to verify, that means you are not crossed the threshold of 148 AD provisions, and you cannot reopen for making fishing roving inquiries. The reasons has to be recorded in the form of show cause, and issues related to service of notice, approval of mind, procedure of reassessment. All these things will continue. Apart from this, you have some new jurisdictional requirements. There has to be information with the suggesting income escaping assessment, prior upload at various stages, inquiry opportunity of being heard in order under section 148A. In case of 153C proceeding, there has to be satisfaction and prior approval. And in case of reopening beyond 3 years, there are jurisdictional requirements prescribed in 149(1)(b) of the Act. Now, some relevant propositions which have come forth in respect of the new law. Azim Premji, Karnataka High Court has held that there has to be a new tangible material if it is beyond 3 years. Azim Premji, Karnataka High Court also held that it is impermissible for the AO to simply merely change his mind and reinitiate proceedings, which means change of opinion has been applied in the context of new law. Madras High Court, we have already discussed, in case of Matthew Chirian, has held that there has to be a live link or nexus between the information and the fact that income has escaped assessment. They have also held that it is a settled position, whether under the old or new regimes of reassessment, issues decided categorically by judicial precedent should not be revisited in the guise of reassessment. So if on any particular issue, it's a concluded issue, you already have a jurisdictional High Court judgment or Supreme Court judgment, in that case, you cannot reopen on the very same issue. The Delhi High Court, in case of Divya Capital, again says that the primary condition of income escaping assessment should still be there. Calcutta High Court, in case of Girdhar Gopal Dalmia, has held that the reason cannot, the report or the order under 148 AD cannot be vague. You cannot reopen based on potential cash borrowings or possible financial transactions. And AO has to independently apply its mind to the information received by Deputy Director. It cannot be on the basis of assumptions and presumptions. So here, you cannot simply rely upon the information received. It cannot be based on borrowed satisfaction. It cannot be based on suspicious assumptions and presumptions. There has to be independent application of mind. The Bombay High Court, again, in case of Naresh Bhalchandra Shinde, has held that fair perusal of the order shows that there is clearly lack of application of judicious mind. Therefore, there has to be proper application of mind before issuing notice under 148 of the Act. Similar finding has been given by Rajasthan High Court that it cannot be based on mere surmises in case of Abdul Majid. So this takes care of the controversies in respect of new assessment reassessment provisions. Very quickly, 5 minutes, what is the fate of the notices which have been issued with effect from 1/4/21 till 30th June 21, and where the Supreme Court has intervened in case of Ashish Agarwal. Instruction number 1 has been issued, which has created more confusion. They have again adopted the travel back in time theory. Assessment here. Firstly, we have taken this argument before the Bombay High Court that if I had not challenged the first notice before the High Court, if it is not pending before the High Court, then Supreme Court judgment would not apply. We are arguing this matter before the Honorable Bombay High Court, but single judge of Honorable Gujarat High Court has held that Supreme Court judgment will apply even if you have not challenged it before the in the first round of petition. In any case, if I have not challenged it before in the first round of petition, AY 13, 14, 14, 15, and 15, 16 has become time barred. What are the arguments available in respect of AY 13, 14, 14, 15, 15, 16? First proviso barred by limitation. The notification TOLA will not have any impact. In any case, we have prejudice, I have defense under 149(1)(b) beyond 3 years less than. AY 16, 17, 17, 18, they have messed it up big time. They say it is within 3 years and therefore please follow 149(1)(a) and please take approval of Principal Commission under 151. The Bombay High Court is hearing this issue. This issue is likely to be concluded in some days' time. According to me, it is beyond 3 years. TOLA does not apply. Bombay High Court in case of Tata Communication has held that. TOLA does not apply to 15, 16 and subsequent assessment years. Once TOLA does not apply, these are beyond 3 years and therefore 149(1)(b) conditions have to be fulfilled and sanction has to be of the Principal Chief Commissioner. We already have a Gujarat High Court judgment in case of Kinara Industries, which applies to AY 13, 14, 14, 15, where they have held that TOLA does not apply to Finance Act 21. Notification does not apply. In any case, cannot override first proviso. And therefore, 13, 14, 14, 15 are time barred. Rajasthan Allahabad High Court in case of Rajiv Bansal has echoed the same sentiments. They said TOLA or notification cannot apply. First proviso to 149 cannot, in fact, Allahabad High Court says that first proviso to section 149 cannot be delayed to 1st July 21 because the argument of the department is first proviso will not apply for the period 1st April 21 till 30th June 21. However, Allahabad High Court, instead of quashing the notices, it was dealing with all 5 years. They say that these are our findings on law. Now you go before the respective authorities and fight out your case. So, in light of Gujarat and Allahabad, I think all 5 years we are through. According to me, all 5 years we are through. But we'll have to fight it out before the High Court, and of course, Supreme Court will take its own course. If the notice was issued before 31st of March, but the department says, no, we have issued, department still goes following Ashish Agarwal and issues a fresh notice. Delhi High Court has held that the notice itself is dated 31st of March, issued 31st of March, Ashish Agarwal cannot apply. In fact, we have seen cases where, in pursuance to notice under section 148 issued between 1st of April to 30th June 21, assessment orders have been passed. Still, they apply Ashish Agarwal and say, no, assessment order is bad in law. They follow some Bombay High Court judgment in case of Amcure Pharmaceuticals and they say, I'll start afresh. According to me, there is no provision in the Act to quash the assessment order. An assessment order can be quashed only by judgment of the High Court. Amcure Pharmaceuticals Bombay High Court was in context of the writ petitions filed challenging 148 notice in the first round of petition. It cannot apply to all the assessment provisions. If you want to quash the assessment order, you invoke section 264 and quash that. But certainly, once an assessment order has been passed, you cannot rely upon Supreme Court judgment in case of Ashish Agarwal and say that we'll reinitiate it again. So I think within the time span given, I'm able to complete most of the things. This is a taxpayer's charter, which please read. It will help you at some stage or the other. And the Supreme Court judgment in Gotla, though equity and taxation are often strangers, attempt should be made that they do not always remain so. And if a construction results in equity rather than injustice, such construction should be preferred to the little construction. Thank you so much for a patient hearing. So Kothari has asked if EO is required to conclude escapement of income at the time of issuance of notice. Does this mean that passing of order under section 143 read with section 147 will only be a formality? Technically, yes. Section 147 is so worded. But now with the Madras High Court judgment, Madras High Court has held that prima facie you'll have to come to a conclusion escapement of income. But if I strictly read 147, they'll have to conclude that income is escaped assessment. And if I read 149 1B, beyond 3 years, there should be an information which should reveal that income is escaped assessment. That should certainly amount to conclusion of assessment. Can we anticipate a second round of which in light of recent Allahabad High Court and Gujarat High Court, the travel back theory proposed by 2 CBDT instruction was rejected? Travel back theory was rejected by, not by Allahabad and Gujarat. It was first rejected by the Delhi High Court, by the Bombay High Court, Manmohan Kohli and Tata Communication, which was approved by Supreme Court in Ashish Agarwal. So that was never the subject matter of contention. I don't know why CBDT again relied on the same theory. They relied on the same theory because they had no option left. So second round of writ petitions, of course, they are still continuing before the high courts. They saved 9,000 notices, Supreme Court. I think now we'll have 18,000 petitions. Search conducted 15/4/21. Up to what period notice can be issued? Is it up to 15/16 or is it 11/12? As per 149, proviso to 149, you can reopen under the old law. If you could have reopened under the old law, either under 147 or 153A or 153C, then you can reopen under the new law. If he wants to reopen EY 15/16 after 31st March 22, and if he wants to go beyond 6 years, then 153A says that income should have escaped assessment in the form of asset. Though 149(1)(b) says income escaping assessment in the form of asset, expense, or book entry. But as per the first proviso, if you want to go back beyond 6 years, you have to go to the old provisions, and under the old 153A, it is still income escaping assessment in the form of asset. So therefore, if that threshold is satisfied, they can reopen. Risk management strategy has been defined in notification number 137 of 2021 e-verification scheme. This is, I think, e-verification scheme. This deals with what information has to be uploaded. But I'm not sure in context of section 148 explanation 1, they have specified that these are the cases you have to reopen. I'm not sure. I have to verify. Prakash, I'll go through it. In recent notice, AO does not even verify the return whether income is disclosed or not. Simply on the basis of sub-registrar information, they issue notice and ask assisted income escape assessment. In this, what reply we should give and what document should be attached? Okay, if the income has not escaped assessment, very well write in the reply to the notice, apply all documentary evidence and say that there is no income which has escaped assessment. That's it. Basic reply, nothing else. On basis of Supreme Court judgment 444, we have seen some of the assessment years. Sanction accorded under section 1 has been accorded by JCIT and not the authorities mentioned in the amenable law. Is it possible to take a view on the basis of Supreme Court judgment para which says that defenses shall be available to the SSC? The ploy of the department seems to be wrong on their part. As the risk management strategy is not defined, can the SSC take benefit of the judgment pronounced in case of DG1 electronics? A, you can certainly argue the old 148 notice had the wrong section because Supreme Court considers it to be 148AB notice. If it has wrong sanction, it even goes. The Supreme Court does not save the sanction under 148AB, it saves inquiry and sanction under 148AA. Therefore, if the notice itself is bad in law under the old law, it certainly is bad in law under the risk management strategy is not defined. Can the SSC take benefit of judgment pronounced in case of DG1 elect? This is a very recent Bombay High Court judgment. In context of old law, where they say merely information received on the inside portal will not suffice to reopen the assessment, certainly you can rely upon the judgment of Bombay in case of DG1. Inquiry under 148A mandatory before 148AB notice. As per the CB, not mandatory because section says if required. Supreme Court clarifies in the judgment that it is only if required. However, subsequently, the department has clarified that all the informations are not correct. Therefore, please verify it. They themselves write in the instruction, please verify it. Therefore, it appears that inquiry may be mandatory in all, may be mandatory. If there is a failure to provide requisite material, can this be a ground taken in appeal or a writ should be filed? Can be taken a ground in appeal or it can also be filed. In either case, according to the judgments which we have pointed out in the presentation, it should go. If you take an appeal route, probably I think they may not be able to set it aside or remand the matter back, which appears to be a beneficial proposition. Giving less than 7 days time. If a SSC doesn't respond to such notice as it is not followed in accordance with statute, can the department take recourse to 292B? In my opinion, in case of estoppel of law, to my mind, 292B cannot be made applicable. You have yourself answered the question. Your answer appears to be correct. Supreme Court has recently held in case of Godrej Sara case that High Court should not relegate the matter to alternate remedy if the challenge is on the legal issue, including jurisdictional issue. Certainly, Prakash Bhai will take into consideration this judgment. Time limit to pass order under section 148 within 1 month from the end of the month. So let's say, for example, notice under section 148AB is issued on 1st March 23 and the basis reply of the SSC under 148 AD has passed order on 20th March 23. Order under section 158 AD can be passed only from the end of the month in which replies. No, the time limit is within such time. Therefore, they can pass order within any period given. So I don't think so. You can take an interpretation that it should be passed only after 1 month has expired. What if order under section 148 AD is passed after 31st March 23 can we take stand that the time limit of 6 years has elapsed, so order is void? No. It is subject to 3rd, 4th, 5th, and 6th proviso to section 149. No reply filed to 148 AB matter is beyond 3 years and it established the assessment that escaped income is only 10 lakhs. Can we argue assessment is without jurisdiction? Certainly, you can argue assessment is without jurisdiction. Ashwin, assessment has been opened after 148A stage for AY 1415 matter and we file objections for the same. Now AO is saying that we can't file objection at this stage. So we're not able to make out. After 148 AD order, 148 notice has been issued. Still, you can file an objection because tomorrow, if you go to appeal, the department can argue, no, you have not continued with your objections in the assessment proceeding. You can file an objection, but then they are not required to dispose of that objection separately. If proviso to 148A is applicable and still AO issued 148, then 148. Can we say that 148 notice issued in pursuance to invalid 140? Certainly, Mr. Cardia, if 148 proviso to 148A is applicable and they have still issued 148A proceedings, I think it will become time bar under 149 because the time limit to reply cannot be excluded because 148A proceedings need not be followed. So certainly it is a good ground to argue. Approval was granted on 5/4/2022 for reassessment by principal commissioner whether the proceedings are valid. I'm sorry, if it is for AY 1516, it has to be beyond 3 years. And then on 5th April 2022, the approval cannot be granted by principal commissioner, it has to be principal chief commissioner. So that is bad in law. What are your views? And now AO is issued questionnaire. Please reply to the questionnaire. The next question is repeated. Notice issued in the name of legal heir, but on deceased plan, is it valid? It is certainly valid. The requirement of law is notice cannot be issued in the name of a deceased person, but they have to assess the estate of the deceased person. They have to reopen in the PAN of the deceased person. PAN does not cease to exist. Because how will then they differentiate between the personal assessment of the legal heir and the reassessment of the deceased person? So notice has to be issued in the name of the legal heir because a deceased person is not capable of replying, but it can be issued in the PAN of the deceased person. Though according to me, there are some tribunal judgments to the effect that the notice has to be issued even in the name of the new entity. Since no separate approval is issued under section 151 under the new law, can we take legal ground while filing appeal and can we ask for approval pro forma after the order is passed? You can certainly ask for the approval pro forma. The Bombay High Court in case of Tata Communication has held that you have to be provided with all details, including the approval. Since for the assessment pertaining to AY 13, 14, 14, 15 having less than 50 lakhs CBDT in circular as procedures to drop the proceeding, AO has neither issued any notice after the circular and not. What is the status of such case? Such proceedings have been dropped, so you need not worry. What if the PCIT gives sanctions to issue notice ignoring the AO comment that no case is made out for reopening? This is a very interesting case that AO is saying no case, but PCIT gives sanction to issue notice. That means there is clear non-application of mine and there is a diversion of view between the authorities and PCIT cannot impose its jurisdiction on the AO. It is AO's belief that income has escaped assessment. Principal commissioner's sanction is of no relevance. There is a judgment of the Patna High Court, Shio Nara and Jaiswal, wherein it has been held that you cannot reopen on the basis of the dictate of the superior authority. That will certainly help you. Mere quoting of information flagged on the Insight portal without investigating the said information by the AO would make reassessment bad in law. Judgment was rendered under erstwhile reassessment procedure. Will this judgment hold good under the new assessment proceeding? Yes, it will still hold good under the new reassessment proceeding. Jurisdictional grounds are not raised in reply to 148A/B proceedings. Can the same be challenged later in 148 proceedings? Yes, Lalit Bhai. Even if you have not raised any objection, you can certainly challenge the reassessment proceedings at the appellate stage or even in the assessment proceedings. 148 notice issued in the name of deceased and 148 AD order issued in the name of legal heir. 148 notice in the name of deceased. 148 is a jurisdictional notice. If it is issued in the name of deceased person, entire proceeding goes.